Now it's recording. So FOMC decision breakdown. What did the Fed actually do? The Fed's new projections, because there is a few new projections from the Fed. And it's kind of interesting. It's a little bit of more slower growth, sticky inflation, and labor as well. So we're going to be looking at those first. Then we're going to go into the Fed dot plot signal that basically is showing fewer cuts ahead. So I think I showed yesterday the CME Fed Watch tool, and that was expecting 2 more cuts from until end of this year, until end of 2025. And actually, it's only expecting 1 now. So we're going to understand why is that, and then, of course, try to understand a little bit more in a sense of how to position about that. And then trading the Fed, what now for dollar, for gold as well, and equities. Okay. So as usual, I need to put up the risk disclaimer. Okay, cool. That being said, let's get out from here. Cool. So first thing we need to do is we need to actually go to the Fed website. For those who don't know, it's pretty easy to access. You just took Fed, and then if you click enter, just type Fed, and you will see the first one already as the Federal Reserve Board .gov. Okay, so if you click on that one, okay, I can just send a link to everyone as well. Just a second. Okay, the link is on the chat, so you can just click on chat, and then you will be able to have the link. Once you here into the Fed board, if you go to monetary policy, you have plenty of options. It's pretty cool, actually, for those who are not too familiar with central banks to come and have a read. There's always those cool stats, and there's always the upcoming calendar as well you can have a look at. But for today, that's not what we're going to be looking at. So if you come into monetary policy, and you come into meeting calendars and information, and you click on that one, then we're going to have the calendar. You have a bunch of them. You have since 2020. So you have pretty much 5 years of historical data. And if you want, you can just come back in 2020, and then you can, March 2020, maybe March 2020, you can just click on the minutes, HTML, and that's going to open up. You can read all of that since 2020. It's pretty good to do, but, it's a lot of time consuming. But if you click on 2025, June 17, 18, because USA is 1 day behind us in Australia. So for us was the 18, 19. And then you have the statement. Okay, so if you click on statement, HTML, or you can click on PDF as well, whatever it's easier for you. I'm just going to go for PDF. It's a little bit better. Cool. So a few things right here at start already. Okay, from open the image. There you go. So from the last meeting to this meeting, so June 18 to, I think the last meeting was on May the 7th. Okay, we had a few alterations. We have a few things that were a little bit different. If we just go here, we will be able to see. So I've already highlighted everything, so we don't need to be going over again. But this happens not that often. Okay, majority of the time is very minimal, and they've took it off quite a fair bit of words, and they've put it up quite a fair bit of words. So what they actually did was maintain the interest rates at the target range of the federal funds rate of 4.25 to 4.5, so basically 4.25 to 4.5, and we can see that right here. Okay. So, but just if we go a little bit on the first paragraph on this one, we can see already that the last month statement was the unemployment rate has stabilized at a lower level in recent months. So as of on this one, the employment rate remains low. Okay. So The next one was uncertainty about the economic outlook has increased further. Can you guys hear me? Hello? Is everything okay? Because some people are saying that the audio is different today. Can you still hear me? If you guys can just send me a message, just telling me if it's good or not, we can continue. Yeah, okay. Okay, you can hear, so that's fine. All right. As I was saying, this paragraph, uncertainty about the economic outlook this is from last month, okay, has increased further. And then when we go to the 18th of June, this today, uncertainty about the economic outlook has diminished, okay, but remains elevated. So from increased further, they continue to say diminish, but remains elevated. The committee is attentive to the risks to both sides of its due mandate, and then they took it off all of this one. So, and the judges that the risks of higher unemployment and higher inflation have risen. So basically, it's not here, of course, but they took all of this off. Okay. And I'm just trying to find, it's over here. So that is the last sentence. That's the last sentence from last one. Okay, so they've took all of this off. Basically, they're not judging that the risk of higher unemployment and higher inflation have risen. So basically, they didn't put it up anything, but they didn't, explain why, or maybe have a higher inflation rate to be continued to go higher or something around that. They just took it off. All of this is still the same. And then we had a few people that were not into the voting meeting. So Neil Kashkari wasn't in there. Musa Lane, Jeffrey R. Smith was added, so that's not in there. And Christopher Waller, and then all of those people were not here as well. Okay, cool. That being said, I think looking at these, we can see that they do have a bit of concern about unemployment rate, taking from stabilize it to remains low. Also, we can see that the uncertainty about the economic calendar has diminished, but it's still elevated. It's not increased in a sense. So, increased further, diminished, but remains elevated. The committee is attentive to the risks to both sides of its dual mandate, and that's it. Haven't said anything else. Okay. That's about it on this one. I think we can move to the next one. Now, if we come to the CME, we'll send a link on the chat as well. We have sent on the chats, so you guys can see that for 30th of July. Actually, let me bring up another image that I had. It's this one here. Yes. So that's May dots and that's June dots. Okay, so let me just divide my screen again. If you come to dot plot here on the first, second, third, and third option, and you click into chart, you'll be able to see this one. Okay, so that's May dots. That's May dots here, and that's June dots. Okay, so basically what they did is they've added a few more, calling for no rate cuts up from 4 to 7. Okay, so there were 4, and now there is 7, and you can see that quite clear here. So 3, 6, 7. I think everyone will be able to see that into their own minds. Okay, so the number of the Fed members voting for no rate cuts this year, it increased from 4 to 7. What does that show to me is that shows that they are a little bit more cautious about rate cuts. And they do think it's pretty much 100% increase from 4 to 7. Just only one person. If we take in consideration that one person didn't vote, that it's pretty much 100% increase from 4 to 7. But anyways, coming back. So what that shows to me is it shows that the Fed is a little bit more concerned about what is to come, because we do have the second round, I would say, from Trump coming over just around the corner at July. Okay, so Trump announced that there will be more tariffs coming. And if there is more tariffs coming, it will be more things to be felt into the economy. Okay, not only the CPI anymore, not only, it's not enough, not only the CPI, not only the previous tariffs, not only Israel and Iran, not only Ukraine and Russia. There's a little bit more to come. So what they're trying to do, they're just trying to be this defensive. Okay, they're just trying to watch of what can possibly go wrong or what can possibly go right, and then they take a step into that. So that being said, I think we can go to the next one, and is the projections. Okay, let me bring up the image. Just a second. I think it's this one. No, that's not this one. It's this one here. Take this out. Perfect. So hopefully you guys can see clearly here, but the Fed forecast is pretty much stagflation. Okay. And what I mean by this is, of course, everyone knows Fed held the rate steady at 425 to 450 as expected, widely expected. I think it was 99.99% expected, but there's a big shift here that came into their projections, and I've highlighted that in red into the image so you guys can see. So basically those ones here. Okay, cool. So there's first is this lower growth. Okay. Second is higher inflation, and third is rise of unemployment. Of course, had a classic stagflation setup. Okay, so that looks very, very stagflation for me. The number of members they've expecting rate cuts in 2025. They jumped from 4 to 7. And then we have that type of projection. In summary, this looks like a stagflation. Okay, so core PC was revised up, and Jerome Powell dropped the recession risk talk. And as a result, of course, we had the US dollar strength, and it's looking like it's going to be extending. Okay, specifically against the Japanese yen and the Swiss franc. So, in my opinion, that kind of looks like a stagflation for me. Okay, so it of course in the longer run, it's 1.8. It's good numbers, but market's not much caring about the long run. It's more caring about 2025, what changes. Okay, and that's the type of things everyone should be looking at, and not only about what they did, hike or pause, because that's really widely expected. So that doesn't change anything into the market, and those types of things, they do change. Okay, cool. So that's actually what the Fed did. Sorry. So now, we've come to this lower growth, sticky inflation. You can see that already. I've showed the dot plot signals looking nice. It's looking a lot to fewer cuts ahead. So what should we trade now? What should we trade? Should we trade US dollar? Should we trade gold, oil, equities, whatever may be there to be traded? Let's go into Finlogix first. So just type Finlogix there. I'm going to send the link into the chat. Cool. And then you come into chart. Is everyone here? All right. So the first thing is we don't have US dollar index here, but let's go to TradingView pretty quick because we do have US dollar index there. Just 1 second. US dollar index. There you go. So, right. Oh, there you go. That's exactly what I thought would happen. So if you go to 15 minutes, and then we go at today, 4:30 a.m. There you go, this one. Cool. So right here was when, well, actually, it was here when we had, the Fed interest rates decision. Okay, the interest rates decision, as widely expected, was paused. So that was the reaction. This red candle here. Let me just circulate that for everyone to see on the US dollar index. Okay. After that, 30 minutes after that, so that was 4 a.m. in Australia. So 4:30 a.m. was when Jerome Powell started to speak. So right here was when Jerome Powell started to speak. And that's the difference, okay? Because when you looked at it, it looks kind of consolidated in a sense, right? We're just looking at a small picture. But what he said was very hawkish, okay? He did have, new projections about slower growth, sticky inflation, et cetera, but that makes sense that they won't be looking to cut as many times as they were predicted to be cutting before. And that is why, US dollar is a bit stronger since this morning. If we look to euro dollar, for instance, euro dollar is falling quite well since the morning, 4:30 a.m. Let me put it that way so you can see. Yeah, so 4 a.m. was here. So that's when Jerome Powell had the decision, the interest rate decision. So it was even a good pullback to long to short it. So if you waited at the right opportunity, you would be looking to short somewhere around here or even here. And you were somewhere around 63 pips in profit. In fact, that's pretty good. One lot would give you around $630 on euro dollar to 500 leverage. So that's the first impact. Okay, so most likely we will continue to see that US dollar index continue to be stronger. Okay. Not sure if that can be above 100. We still have tomorrow. If we see a break above that area here at around 99,400, then yeah, most likely we're getting back to 100. And then, of course, euro dollar will continue to go down. US dollar yen will continue to go up. And that's when some trade opportunities will be most likely coming, at all mines. Now, if we look at oil, of course, oil has pretty much nothing to do with interest rates decision. You can see that right here. Let me get that time back again. So midnight, 4 a.m. So that was at 4 a.m. when they had the interest rates decision, and then at 4:30 it's here, and nothing really happened. From this to this, it's pretty much nothing compared to euro dollar, for instance, or US dollar yen, or even US dollar index. It's nothing of a move. Now, that is another one. I think oil is much more related to the conflict than anything else. Okay, so we do have CPI data, PMI, PPI, GDP, whatever you want to have. That won't affect much because it's a different market. It's a different structure. It's a different structure of sentiment. Okay, and that is, and I think I've told everyone about the Strait of let me just, I think it was Don't know how to write that. I think it's like this one. Let me have a look. No, not this one. Straight oil. Yeah, can't remember. But anyways, oh, there you go. Maps. Iran, Israel. There you go. We can see it right here. Just open Google Maps so you guys can see it. So see this one, this little part here, okay, it's where 1/5 or 1/4 of oil around the whole world, so it can affect me, it can affect you, it can affect Ethiopia, it can affect everyone around the world, Russia. It's passed through here every single day, okay? And we're talking about Iran right here, Israel right here. So yes, of course, there's not, it's pretty far from where they are. They're having the conflict, but still, if anything happens, and maybe Israel wants to go through this road and want to impact on this side of the Iran, that strait will be definitely affected. And if that straits get affected, then we have continued pressure, bullish pressure into oil. And then we're talking about $80, maybe we're talking about even $90. Not too sure. It will depend on the pressure of the fundamentals of what can possibly happen. Okay. So in my opinion, oil is not too linked into data. Yeah, it can be sometimes, but not 90% of the times, just maybe 10 to 5% of the times is more linked into data. And when we have something happening around this area here, then of course oil gets impacted. Okay, so just watch out for developments into Iran and Israel. That being said, Iran and Israel, if you search Iran and Israel and Trump is trying to, in a sense, help Israel. Okay, and he even wanted to. I didn't understood pretty well, and that doesn't make any sense in my opinion because, anyways, I think Trump is a little bit out of his mind. But Trump is pretty much considering attacking Iran, and and he's holding a very crucial meeting with his advisors, as he liked to call, according to Walla News that I read it this morning. Another thing that I saw is that he wants to bring Iran into the White House to have a chat. Okay, so I'm not too a fan about that. But if that actually ended up happening, we will have big problem. Okay, so just watch out for any developments, and I'll always be keeping everyone informed. So if that happens, we most likely can be looking to long oil. Let me just take this thing here. Maybe stop losses below the low around 71, 500, 600. And the take profit, just going to leave that open because, tends to continue. It tends to not stop for a while. So that pressure will continue to be on. The bullish pressure will continue to be on for who knows the time. Maybe another 2 months, maybe another 1 week. It just depends how all of that will be going. And then once something happens and it changes the character of the market, of course, we get out. Cool. On gold now. Of course, gold always have fill, okay? And I've mentioned about that pullback into 3,000, around 3,355 and 3,325. Now I'm looking to start to long gold somewhere around these levels. What I'm waiting for is, well, let me just go into maybe 4-hour chart. A little bit easier to everyone to see. Take this off, this one as well. Okay, so what I'm looking for is a break above the 3,500. Okay, so that is the all-time highs, pretty much 3,500. Must be like 3,500 and something, but just here it's fine, 3,500. And it looks to me a very good risk-reward setup here, because when we have that sort of pullback and maybe a continuation up around 3,500, we're talking about, how much we're talking? Nearly 5% of a move. Of course, that's going to take time, and it's not going to be like from today to tomorrow. But starting to position myself around this area would be great for me. Okay. Sorry, there's someone. Okay, well, no, I'm done. So looking to position myself around this area to gold provides me a good risk reward. I'm safe in a sense, because majority of the investors, once they have that kind of news, that kind of news that USA is coming to fight, they will be looking to move the capital into safe storage of value. And you can see already that gold is pulling back. Anyway, so here would be great around these levels. I would, of course, prefer around 50% of those two levels. So that would be, give you specifically the number, 3,340. So if that gets to 3,240, that would be pretty awesome for me. And I would be looking to long gold until 3,500, or even a break above that levels, managing the trade afterwards, maybe trailing stop or anything like that. Stop losses would be around these lows. But of course, let me just double check one thing. There you go. And that gives us a 1 to 3. That's pretty good for gold. That's a 4-hour chart, of course. If you are a little bit more of a day trader, I like to do swings, but if you are a little bit more of a day trader, you can wait for, on a smaller time frame, you can wait for continuation of this pullback, break of structure. It just depends how your strategy will go. Then enter into a smaller time frame and position your take profits around 3,500. Now, if anything continues to the way it is, market is a little bit more risk off. Okay, so if you look at Aussie CAD, for instance, I've been mentioning about that one for quite a while. We can see that it's went all the way up there. Now it's pulling back down. So I do believe that can continue to go lower. Okay, why? Because Canadian dollar is really, really, really strong when oil is going up. So whenever we break this 74,600, 74,62, we will probably see NZD CAD going down, Aussie CAD going down, CAD yen, this one here, going up. Okay, so that's a good pullback to be looking to long maybe as well on CAD yen, and then having gold as a protection for anything that can probably happen around the next couple of hours even, or if you blink, you miss something on those days. Anything. So next one, of course, would be short Aussie against the US dollar. Or we having DXY continue to strengthen. Aussie dollar is mainly a risk-off currency, but when there is risk into the market, no one wants to touch that. So that continues to be very bearish, especially against the US dollar when you have, back in some sense of back to storage of value being created into the US dollar. We see that the Aussie dollar tends to perform very bad. Okay, so I wouldn't say to be looking to short at this level. 0.64, 651. I would most likely want to wait for a pullback at least, just because it's right on the lows and it's in a sense cheap to sell at the moment. I want to sell expensive when I buy cheap. So maybe when we have a further retracement around those levels and then a pullback around somewhere 64, 65, I would say would be perfect. But 64,800, I'm looking to start my positions. Okay. And always watching out for conflict and for the US dollar index. Okay, cool. All right. I think that's pretty much it from me today. Do you guys have any questions related to what's going on, or maybe, trading in general? No questions? Has been quite a hectic week, I know. Okay, cool. I think I've made very clear on Telegram as well about the about the FOMC and the Fed in general, about what can possibly continue to happen with the US dollar. Shaq saying it, Nasdaq 100 and S&P 100. Let's have a look at Nas 100. Is anyone trading Nasdaq 100? I found to be very ranging the last couple of weeks. We had a bit of move up here, and then just ranging from there. Nothing changing much. Okay. Well, I think Nasdaq, there's no influence into Iran and Israel. Okay. I think Nasdaq is much more influence about US dollar plus the Fed. And trying to speculate into Nasdaq, I would say, let's say 50 minutes. Coming around the levels of 21,300. 21,300 would be quite decent. Just more plain technical here, we see that there is a consolidation between the levels of 21,500, wow, perfectly, and 22,000. Oh, wow, that's a pretty good range, $500. 21,500 to 22. If we see a break below 21,500, we wait for retest and then looking to trade into 21,200 or 21,300, around those two levels. Okay. Nasdaq, I don't really think Nasdaq would have any impact on oil or anything related to the Iran and Israel. I'm looking here the last Friday when Israel attacked Iran, we had a massive bullish candle. So just watch out for any development that it can probably continue to melt down, and that trade can probably be very good to short after 21,500. If you are confident, then yeah, why not start to short already at 21,600 where the price is at the moment. Cool. All right, that's good then. I think we came to an end. Just let's go over everything again. Where's there you go. This one. So what did the Fed do? Well, basically they held the rates steady at 425 to 450, as widely expected, and nothing changed. Now, the second was the Fed's new projections. It's slower growth, sticky inflation. They had a big shift, came into the projections, and it's slower growth, higher inflation, rising unemployment ahead, and that basically gave us a stagflation. Stagflation was when the inflation continues to not go anywhere and the growth continues to slow. Okay? So the sticky inflation doesn't mean that inflation will continue to go higher. It just means that where it is, it will stay for quite a while, and it won't change for maybe a few months or a few quarters, and it will stay there for quite a while. And that's the stickiness of the inflation. And combining a slower growth with a sticky inflation, we have the stagflation set up. Cool. The next thing is the Fed's dot plot signal showing us fewer cuts ahead. So the number of members expecting no rate cuts in 2025, it was 4, and now it's 7. So it jumped from 4 to 7. And the Fed quietly raised its 2026 rate outlook. This is very hawkish. And the market, of course, is reacting. We saw US dollar going up, we saw euro dollar going down, we saw Aussie dollars were going down, oil went up because of Iran Israel, Canadian dollar went up because of oil, and it goes like that. Next thing was that the core PCE was revised up, and Jerome Powell dropped the recession risk talk because we saw that. Let me just open that image again, just 1 second. This image here. Yeah. So you can see here that they took it off the whole thing about has stabilized at lower level in recent months to remains low. So it didn't have any change in a sense, but it continues to be low. Next thing was it was about the Iran and Israel, and about Trump maybe possibly having serious talk about his advisors about joining the war on supporting of Israel. That happens, that would be really, really bad for for all of the people around. But most likely we will see gold flying. We will see NASDAQ probably dropping, because NASDAQ is a risk-on sort of asset. So all of those type of risk-on would be out, and risk-off would be coming in. Cool. That's about it for me today. Hopefully you guys could enjoy a little bit and could bring some sort of light in the tunnel for everyone. Tomorrow we don't have webinar as usual. It's Friday. I will be back on Tuesday from 4 to 5 p.m. And of course we do have the Telegram update every single morning. Just today was a little bit busy. I couldn't do it in the morning, and I did it in the afternoon about the Fed. Okay, cool. Thank you so much, guys. Hopefully everyone have a nice weekend, and I talk to you tomorrow in the video, or talk to you next Tuesday. So see you guys. Bye bye.